A conventional loan is a fantastic mortgage to look at getting into this year. The reason being, there are so many options available of how you can use this loan product. Not only do you have the most property types available, but you can get into a home with as little as 3% down if you are a first-time home buyer. That is a real thing with this loan product. That's lower than what an FHA loan allows you to do. It is the lowest down payment option available to people that do not have special circumstances and backgrounds. I would highly encourage you to look into using this loan through your local mortgage advisors or whoever you're working with to secure a mortgage for your first, second, or even 20th property this year. I'm Hannah Escher. I'm a mortgage advisor, and I'm super excited to share all of my tips with you. Let's dive in. So first, what is a conventional mortgage? Well, simply put, a conventional loan is a loan that is not insured by the federal government, such as FHA, VA, and USDA loans are. A conventional loan is going to be backed by private lenders, banks, credit unions, and mortgage companies. A conventional loan also has two different types. One is conforming and one is non-conforming. Today, we're going to be really talking about more of conforming conventional loans, which follow Fannie Mae and Freddie Mac guidelines. Fannie Mae and Freddie Mac are large organizations that are called government-sponsored enterprises, and they buy and sell mortgages. Now, one of the reasons a conventional loan is very widely used is because there are many different usages for it. Some loans, such as an FHA loan, can only be used for primary residences. However, if you're using a conventional loan, you can use that for a primary residence, an investment property, or even a second home. This is one of the reasons why conventional loans are widely used. Now, today, we're going to be focusing mostly on primary residence conventional loans and what those guidelines look like. We can cover investment property and second home loans in a different video. So for primary residence conventional loans, there are very many different ways you can get into that loan product. One of the big myths around conventional loans is that you need 20% down to be in this loan. And that is completely incorrect. And that is a myth that has been around for many, many years. So let's correct that right now. If you are a first-time home buyer, you can use a conventional loan with as little as 3% down. Let me repeat myself. You can use a conventional loan if you're a first-time home buyer with as little as 3% down. And that product is offered by Fannie Mae and Freddie Mac. And there are multiple types of products that offer this for first-time home buyers. If you're not a first-time home buyer, you can use a conventional loan with as little as 5% down. So as you can see, you do not have to have 20% down. Now, one of the perks of having 20% down in a conventional loan is that you won't have private mortgage insurance, or PMI. I'm sure you've heard of this term. If you have a high credit score and your debt to income ratio is within the range of where it needs to be for a conventional loan, that PMI payment is going to be quite affordable. I'm talking $100 to $200 a month in most cases. And I could tell you from personal experience, the first loan I got with my first house was a conventional loan. I actually even used down payment assistance, but I came into that loan with 3% down. My private mortgage insurance was under $200 a month. I just purchased my second home with a conventional loan with 5% down, and my private mortgage insurance is around $200 a month. So if you have 20% down, that is fantastic, and you will not have that private mortgage insurance. However, if you don't have 20% down, it's also okay, and in most cases, it's going to be very affordable. The one time with a conventional loan that private mortgage insurance gets expensive is if you have a low credit score. If that is the case, though, a conventional loan may not be the best fit for you. So that's where you'll want to speak with your mortgage advisor about what other options might be available to you that are going to give you more affordable terms. Another tip is if you don't have 20% down, you will reach that 20% equity point at some time in the life of your loan. And when that happens, another great feature of a conventional loan is that the private mortgage insurance can be removed. So that is another reason conventional loans are very popular. They have great features, great terms, and are most of the time going to be the most affordable option if you have a high credit score and a good debt to income ratio ratio that falls within the ranges that Fannie Mae and Freddie Mac have set for those conforming conventional loans. Another perk of a conventional loan is that you can use it for a wide variety of property types. For example, if you're using an FHA loan, condos are not always going to be approved through FHA financing. However, if you're looking at a condo and using a conventional loan, it's highly likely that condo is going to be approved. Now, the condo still has to be reviewed by underwriting, and all of that has to be verified for final loan approval, but you are much more likely to be able to get that property type with a conventional loan. Again, it really comes down to the variety and multiple ways that you can use this loan product, which is why it's so popular. To recap, a conventional loan is not insured by the federal government. It's offered through private lenders. There are a multitude of down payment options available to you depending on your situation. And you're going to be able to shop for the most property types most of the time when you're using a conventional loan. That's it for today. I'm Hannah Escher. You can find me at hannahescher.com. If you found this video helpful, like and subscribe to the BiggerPockets Rookie YouTube channel. Thanks for watching, and I'll see you next time.